Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks sinking here as the war in Iran remains front of mind for investors and oil prices spiking. Yahoo Finance's Jake Conley and Inez Ferre joining me now to talk about it all. Jake, I will start with you. Let's just talk about this sell-off, Jake. Stocks in the red, crude moving sharply higher. You have your benchmark 10-year, Jake, back above 414. What do you make of it?
Look, this market is selling off right now. Let's look at some of these numbers. The S&P down 1.2% right now. The Dow even deeper, down 2.2%. The 10-year, as you point out, up 5.4 basis points, back above 4.1%. And WTI today, cracking 80 for the first time since January
81
25.
here. Yep.
This is a market under stress. A few days ago, it looked like things were kind of leveling off. Oil held steady over the last 24, 48 hours.
How much do you think, Jake, that was about what we've been discussing, which was Trump's post saying, hey, listen, Strait of Hormuz, I got you. If you need a naval escort, order it.
Well, I think that was part of it. But at the same time, you immediately saw the market correct because people in the space started saying, I don't know if this works long term. What does this look like? Is this going to get retribution from the IRGC? You know, what is this hearing? Just hearing from a source of mine, one of the major insurance clubs is thinking about re-offering war risk premiums. So that could be a sign that people are starting to assess that maybe we should start moving back across the strait, but I think it's way too early. Today, the market's reading all that stress.
And so I think the market is queuing off, as Jake points out, what's going on with oil. And when WTI is making these kind of moves, investors, of course, suddenly get a lot more nervous about what it means for the consumer, the engine of our economy.
Yes, and what it means for inflation. I mean, if you take a look at gasoline prices, they have gone up 25 cents over 3 days. You're looking at diesel that's gone up more than 40 cents over the last 5 days. So it's at 2023 year highs. And when you think about diesel that is used for trucks and the majority of cargo that goes through the U.S. via trucks, 70% of that. So that means groceries, that means deliveries, anything that you can think of that will require diesel as its fuel. And so those prices may not be immediate necessarily for transportation costs because there's contracts that are in place. But once those contracts renew, that's when you see the prices going higher. And so one strategist said to me, look, this doesn't make the headline diesel compared to gasoline, perhaps, that you see it spiking higher, but it will have an impact on inflation. And I think this is why you are seeing the markets also going lower, because this means now, is the Fed not going to cut rates now? Because this is what we are seeing is inflationary the longer that oil prices stay higher. And by the way, it's not just the fact of oil. Now they're talking about fertilizers that are supposed to go to India, and this is going to impact crops. So all of this is having an impact on the market.
So Inez brings up that good point about what the Fed thinks of all this. You know, Jay Powell is watching these moves in the energy market. What do you think he's thinking? Or do you think he's thinking through this?
In the past, I think the Fed looks through this a lot of the time. But increasingly, you've seen a few governors come out, Neil Kashkari, a few others saying, look, it's too early to make a call based on this, but it is going to make the job a little harder. It is going to make us sit back and say, is it time to keep easing? Is it time to keep bringing those rates down? This is going to make Kevin Warsh's job harder for sure, because he's going to be getting pressure from the administration to cut. And at the same time, the Fed governor is going to be looking at this and saying, if this doesn't go away, what's this going to do to inflation? A report out of Politico today, CENTCOM, the military leadership, internally saying the war could last through September. If that's true, energy prices will remain elevated. That's going to push inflation up, and it's going to make the Fed's job harder.
You know, Jake, when we talk about, in terms of, you see commodity spike like this, in terms of what it means for a stock market investor, you immediately go consumer discretionary, you go retail. I was talking to Praz on the show this week about what it means for airline stocks. On the flip side, though, does it mean a certain tailwind for certain sectors or verticals, certain names, for example, in the energy sector?
Yeah, I think it can. It can. You know, you look at the U.S. energy sector in the S&P, the best performing sector in the S&P yet this
year to date, before this year.
Before any of this started, right? The strongest sector in the S&P. And I think this can be bullish. You see those stocks coming up, but realistically, it's too soon for those big producers to start saying, all right, let's get the rigs going. Let's start drilling again. Let's start pulling oil out of the ground. You could still see some tailwind, but I think it's too early to see that. I think a lot of these industries are going to say, that could have tailwinds, are going to say, it's too early to know where this is going to go, and whether, you know, is a major industry, is GE Vernova going to suddenly ramp up production because energy prices might be spiked up for 2 weeks.
I will say that one of the sectors that Wall Street has been also looking at is aerospace and defense, because you had seen those near highs. And one of the strategists from Fundstrat was talking about the fact that you used to see buying up to a conflict and then you'd see flattening out. But now, because of this feeling that there's this persistent geopolitical risk, that conflict is pretty much constant, then now you're seeing these stocks that are higher for longer that perhaps are also even overvalued.
Yeah, and I think that's a good point about the geopolitical risk environment we're in. This is not just Iran. Go back to January. This is Venezuela. This is the tariff regime from April last year. This is the comments about Greenland, right? The market's just reevaluating a position where there is just more of a geopolitical, risk premium over everything, and that's going to play into how these stocks are valued, I think.
And this final quick question on Bitcoin. What do you make of the move, Tick? We're back in the red, down about 4% to 71.
71, and we were at around 73 yesterday. Look, this was one of the risks that had been talked about, is if you see oil sustained higher for longer, this will impact the macro backdrop. And so that's one of the headwinds for Bitcoin going forward. I mean, there is also a lot of talk about global liquidity and the impacts that has on Bitcoin, and that you are in a downtrend, but still one of those factors being if everything starts going south economically wise, or inflation goes higher and the Fed does not ease, then you could see headwinds for Bitcoin.
And at the same time, VIX back over 25 today.
Good point. Inez, Jake, thank you both. Appreciate it. Well, let's take a deeper look now at the markets today. We're seeing widespread sell-offs in the trading day as conflict in the Middle East sees no signs of softening. U.S. Bank Wealth Management's Rob Hayworth is with me. He's their senior investment strategist. Rob, we'll just start. Ongoing war with Iran. You see sell-off in the markets today, I think, chewing off what you're looking at, the surge in crude. What do you make of it? What are you telling clients?
Yeah, I think if we go back to Saturday, what the market is, and what we're really trying to think about is duration. How long is this going to go on in two ways? One, how long will Iran's offensive capacity stay? How long will Iran be able to sustain their offensive capacity? And two, how long will the Strait of Hormuz be shut in? Because that's going to detail for us how far the price of oil goes and what is the impact on the economy. So, the way we're seeing it right now, I think the solid news for investors is the S&P 500 is breaking down, but we're not taking out real lows yet. You're still well above November lows. You're still above February lows.
Actually, in some ways, does that surprise you, Rob?
Yes.
Given what we're watching?
Oh, yes.
Yeah.
I mean, with oil breaking above 80, right, I think you would have expected to see more of a downturn. But we've seen investors stay in the U.S. market.
How do you explain that?
I think, one, we already had our sell-off in software.
Yep.
So you already saw that reprice. And two, investors were already underweight energy and needing to catch up, already underweight utilities needing to catch up, already underweight industrials and needing to catch up. And I think that's the rotation we're seeing amongst the stocks. I think the one concerning thing I'd point to today is actually the weakness in small caps. That's what's telling you this market is concerned the Fed's not going to be cutting rates, and we need to watch that closely.
What do you think the Fed is making all this?
I'm not sure their position has changed a lot from December. In December, what we saw in the dot plot was 17 members who didn't agree on where we should go next. Some of them thought we needed to cut, some of them thought we needed to stay. There was no central consensus other than we could identify a median of maybe one cut. And what we've heard from speakers so far is they don't know. I think the key will be the labor market. That's what we have to watch. Yes, inflation could go up, but we all hope oil prices higher is a transitory sort of factor. But the labor market is what they will respond to and will cut rates. If we start to see jobless claims tick higher, which they haven't been, if we see the jobs market weaken, which we'll get a report Friday and we'll know a little bit more about that, those will be key factors that will probably catalyze this Fed into action. And otherwise, they can maybe wait and see what happens.
Let me ask you about these moves you see in the bond market. Your benchmark 10-year, Rob, it is back to above 4.14 here. What do you make of that move?
Yeah, it's, well, one, I think you're seeing people have to price in inflation expectations, right? We were down close to 4%. We were expecting cuts. We were expecting lower inflation. They're having to price up inflation expectations. They're having to price up a risk premium too in terms of real yield, right? They're starting to price both of those higher. That said, you look at the little longer term, you've been between 440 and 4 for quite some time, right? This is not a bad spot for the 10-year Treasury to be. It's not helpful if you're looking to get a mortgage, but it's been fairly stable, right? And all the action is really on the short end for what is the Fed going to do.
I know you talked about some potential opportunities overseas, Rob. I guess one, where overseas, and two, did your outlook change at all about opportunities given what we've been seeing?
Yeah, I think for us this goes back to the duration question, right? The longer this goes on, the more I think we need to reevaluate what is the potential overseas. But in the meantime, you have one, cheaper valuation, and two, you're seeing earnings expectations improve outside the U.S. as well, right? So I think for us, we're thinking globally diversified is okay because we pick up some of those other sectors we were talking about, industrials and energy, in higher weights than we get in the U.S., which is still a very tech-dominated index, the S&P 500. So we're getting some benefits from foreign exposure, but we'll have to watch that as this goes on, right? The longer it goes on, and in particular, the longer you ask Europe and Asia to do without oil supplies, I think it makes for a tougher road.
Bottom line for investors, I guess, Rob, and this is a tough question because people are listening right now. I realize that different cash, different coverage, different time horizons, but are there broad takeaways for portfolio position? I mean, when you see this many moving pieces, is it just stay disciplined, stay diversified? What would be your takeaways?
Yeah, we would definitely say diversified, but I would think about a couple of things. One, on the bond yield side, you're getting better yields than you've gotten in 10 years. So interestingly, you don't have to take as much risk as you used to achieve the same objective. So we'd look to fixed income as a reasonable place to be. Two, we'd look to get some inflation protection in portfolios. Global infrastructure has held up very well. It's a sector that's 50% utilities, 10-15% midstream energy, right? You're getting some cash flow, you're getting some inflation protection. We would look there as well. So there are places to be in this market, and investors should start to think about maybe rebalancing, and if they're not invested, this is a good time to start dribbling in, right? Prices are a little bit lower. So it's a good time to start thinking about building some of those protections in your portfolio.
Where are you finally, because I know you mentioned software when we started the conversation, where are you in that sort of great AI trade and theme?
Yeah, we still think that there's a structural tailwind to that, right? We have questions to answer, but it's an investment story where the hyperscalers are upping their investment by 30% in 2026 alone, according to their fourth quarter reports. So this is a story that we think lasts and has legs. Now, we may need to reposition who the winners are, but we're seeing that there are more winners through the whole ecosystem, right? In order to support the hyperscalers, you're not just having to buy the hyperscalers and the AI chatbots, you're having to buy infrastructure, you're having to buy industrials, you're having to buy energy and utilities, because we need all that to finish this out, to finish this structure out. So we're seeing more economic winners from this story in the long run, and so we think it's worth pursuing in over time.
Rob, great to have you on the show, especially on SED. Thank you.
Thank you.
Coming up, we discuss the outlook for Nvidia's China business. That's next on Market Domination. Markets digesting a lot right now. I got stocks selling off, geopolitical risks tied to the Iran conflict, and a rapidly evolving tariff landscape. All of this coming ahead of that critical jobs report on Friday. For more, we're bringing in Lorena Arucci, chief U.S. economist at T. Rowe Price. Lorena, it's good to see you. Why don't we start where investors are focused today? That's the oil market. You have WTI now back above 81 here, Lorena. The chances of a new energy-driven inflation shock. Let's say clients, smart clients at T. Rowe Price, they ask you odds of that. What are you telling them?
I think right now we don't have enough information to determine if there's going to be energy-induced shock, a permanent shock to inflation and inflation expectations in the U.S. So the factors we need to watch are how far can we go on the energy price increase, $10. I think it's quite significant, but I would be very concerned if we hit the $100 per barrel mark. I think that's going to have more of a lasting effect.
If it hits 100, how long does it have to stay there?
We're looking at least a couple of months of sustained higher inflation, because then we know that it's going to feed through to gas prices at the pump. And it's one of the things that consumers buy on a daily basis. This is, I think, what will concern the Fed, because it can de-anchor those inflation expectations, especially because core inflation has been around 3% for quite some time now. So we're already approaching inflation from above target. So I think for the Fed, right now, they must be feeling good about the fact that they indicated they want to wait and see instead of cutting interest rates further. This validates their reaction function for the first half of the year. And then when it comes to the second half of the year, they can wait and see how far oil will climb, how long it will stay there before making the next policy move.
I've had some folks on the show, Lorena, suggest that the U.S. economy, they argue, is more relatively insulated from any kind of oil spike than versus years past. Do you agree with that?
Absolutely. I think the U.S. economy has gone through a period of transformation in terms of energy independence, and we are actually a net exporter now. So when you look at countries in Europe, they're being really affected, especially by higher gas prices. We are much more sheltered here in the U.S., and that helps the consumer through the utility price tag as well, not just at the gas station. So I think the U.S. is diversified. We're looking at a drag to growth from higher gasoline prices because that hits real disposable income of consumers. So how much consumers have left at the end of the day after buying necessary things. And that's going to drag growth. But then you have to look at the positive impact on the oil producers and the manufacturing sector in the U.S.
As the consumer navigates these dynamics, headwinds, Lorena, how would you characterize the consumer? How healthy, how resilient?
So it's a challenging time for the U.S. consumer. We've seen that for some time now. But then time and again, when you look at retail sales and consumer spending over a one-year trend, the U.S. consumer continues to go out there and spend. We know structurally it has a healthy balance sheet, and credit conditions have actually eased in the last few months. So I think the U.S. consumer remains in a relatively healthy state, but of course there are pockets of weakness, and there are some challenges there, especially for the lower income consumer. What we know also is that this tax season, the low income, middle income consumer is going to get a bigger tax rebate than in prior years. So hopefully that offsets some of that drag from higher energy prices and keeps consumer spending smooth this year.
We talked energy, let's talk some trade policy too, because Besson says that 15% global tariff that could come this week, right? I'm curious as an economist how you think through that and its impact.
So we had an effective tariff rate before the SCOTUS decision that was higher than where we are right now. So I think this announcement that they're going to increase tariff rates to 15% brings us back to where we were before the Supreme Court ruling on IEEPA tariffs, right? So I don't think macroeconomically speaking, it's such a big difference for consumers and importers. I think what the US is trying to do right now is differentiate between those countries where they were on a path to a trade agreement and countries where they weren't on that path and are probably going to impose 15% tariffs, not across the board on all countries, right? But just some trade outliers. The inflationary effect, I think, should be manageable, and the uncertainty shock is nowhere near comparable to what it was during Liberation Day last April. So I think we're in a spot where we can navigate this trade uncertainty right now.
A big jobs report tomorrow. Walk me through your forecast, payroll growth, wage growth, unemployment rate. What are you expecting?
So consensus right now is somewhere between 50-60K payroll increase per month. I do think risks around that forecast are balanced. What we saw in January was unusually strong report given where the break-even rate of employment growth is for the US right now. So I don't think we see a repeat of that. We are seeing some encouraging signs of improvement in cyclical employment. A lot of employment in the US the last few months has been driven by the government sector and healthcare. We're now seeing more broadening of employment growth, especially from small businesses, medium-sized enterprises. So I expect a continuation of that. I think that makes the economy more resilient on balance. I think the unemployment rate remains stable around where it is right now. And I don't think the conditions are there for a tight labor market that would push wage pressures higher, if anything, because we've had a revival in productivity growth the last couple of years. We can sustain slightly higher wage growth without it being inflationary. So overall, I think the labor market will be a source of strength for growth, but not necessarily push inflationary pressures up this year.
Finally, Marina, a lot of hot talk on this table about AI, how that could impact the labor market, people trying to gain that out right now and ahead. You must get that question from friends and family. What do you tell them?
We're talking a lot about the effects of AI on the labor market. I think it's too early for it to have a big impact at the macro level, but we're certainly hearing anecdotes of how companies' appetite for hiring has come down, either because they're making their workers slightly more productive, and the productivity data is telling you that, or because preemptively, in anticipation of a bigger or steeper adoption curve, they may not be wanting to expand the labor force and then fire. So I think it is having an effect in the labor market. It's just, I think, early days for it to have a very meaningful impact, but that's probably coming in the next few years.
All right, Marina, always so good to see you. Thank you.
Thanks for having me.
Well, Nvidia is making a pivot on its China strategy. The FT now reporting that the tech giant is stopping production of its H200 chips destined for the Chinese market. Instead, Nvidia plans to shift capacity to focus on making its next-gen Vera Rubin hardware. Dan Howley, of course, is with me for the latest developments. Daniel, great to see you as always. So let's talk about this. The report is Nvidia is halting China-bound H200 output. So I will double barrel this. What is H200 first? Explain that for us. And why do you think Nvidia could be making this move?
So H200 is the Hopper chip that they had. So H Hopper, pretty easy. B200 is the original Blackwell chip. B300, Blackwell Ultra. Yada, yada, yada. This was going to be the chip that was going to go to China, right? The U.S. had said, all right, you guys can ship it. We'll take a little slice of the pie when you get the cash for it, and that's how we'll roll if China plays ball. And so far, we've seen reports of China saying to certain companies, Alibaba, what have you, that, yeah, go ahead, you can order them, but in like limited quantities. We've seen reports of China saying nobody use homegrown chips. And so on NVIDIA's most recent earnings call, Jensen Huang, the CEO, had said, well, we've got no revenue from China. That's just not happening. And when they did their outlook for the current quarter, they said, this outlook has no China revenue built into it either. We're not expecting any, we don't know what's happening. So it seems as though at this point, they're just kind of saying, we're not getting orders, we don't know what's going on. We have huge demand for Vera Rubin. Why are we just sitting here wondering if we're going to get something or not when we have definitive orders? Let's just go ahead and start making those fly off I mean,
well, this is why I want to ask you,
but
did you look at that and say potentially, is this sort of like a bull? If I'm an Nvidia investor, do I think actually this is a good sign, because is it Jensen saying, well, you know what, I'm shifting capacity. Forget the H200, man. I got this demand from my Vera Rubin, the new hot stuff. It's hot. It's flying.
I think it can be two things, right? The first is, yeah, Vera Rubin demand is there. They've said several times that Vera Rubin demand is off the charts, as well as demand for prior generation chips. They've said that even chips that are 6 years older are getting love as well. You know, Jensen's thing about getting into China is when you have an American chip in China, you allow that to thrive, and then you have a country that's dependent on a U.S. company. And so that allows all kind of boats to rise, specifically U.S. boats. That's the thinking there. But at this point, it seems as though this has just been so many starts and stops that maybe they're just saying, look, we have outrageous demand. Let's just go fill it with what we have. You know, get those lines going for Vera Rubin, and we'll be able to bring in a ton of cash on that. That you don't have to split with the government either. Not split, but take a cut off of. I think it was 15% last time we had seen. And so that to me is in my mind where this kind of strategy fits in, and it makes sense. You have a company that has a product that's highly desirable. Everybody who's in AI is trying to get their hands on it, and if they can, great for them. So why not just start sending them off the line, and now you'll have more to sell later. So I mean, it does make sense.
What about this broader question about? Some folks say you should be, since we're talking about China and AI, some smart folks in the industry say, what are you doing selling your AI chips to China in the first place? Are you nuts? You don't sell your superpower to an adversary. On the flip side of the coin, folks say, Dan, if you keep these export controls in place, you're going to actually unintentionally encourage the Chinese homegrown domestic players to really up their game. Where do you come down on that?
It's hard, right? Because smart people, Dario Amati, he's the head of Anthropic.
Swinging on that.
He said that it's the equivalent of giving a nuke to your adversary,
talking very tough.
China's an adversarial country. It's a nice phrase to not say enemy, but not say best friend. And so, the U.S. has said, look, we don't want to give you guys carte blanche to get these chips. We want to make sure that things are good for us. And you've had some lawmakers say that we should do that. We shouldn't allow our prized possession go over to China and potentially build out their AI so that then they can have that spread throughout their military, their companies, and then put up a bigger challenge to the U.S. The flip side, though, as you say, is okay. So they don't have access to these chips. Well, now you're just going to go ahead and make them build out their own chips that could be just as compatible or just as capable eventually. And then there's nothing that would put a kind of governor on their ability to grow their AI, because they're no longer dependent on the U.S. And it's kind of similar to what happened with Huawei, right? You cut off Huawei from chips from the likes of Qualcomm and that kind of technology. And then they went ahead and said, all right, we'll just build our own chips now. And now they have competing chips. And so they had a market that was dependent on a U.S. chip. Now it doesn't matter, right? And so they just went out and built those chips. Now, I'm not saying that it's apples to oranges. They're very different technologies. They're very different purposes. So perhaps it's easier to build a chip for a phone than a data center. I would assume it is. But that's kind of the back and forth between these two, and it's honestly, hard to say who's right and who's wrong. I think it depends very much on where you fall on national security and how AI plays into this. And, obviously it plays a major role. We've heard that the Trump administration is using Anthropic's AI models in Iran right now and used it.
Yeah, the Journal had that. Yep.
So, it's clearly not a pie in the sky idea that AI is being used for military purposes and will be down the line. So, it really comes down to where you fall on that.
Sticking with NVIDIA, here's another headline. NVIDIA's Jensen Huang says that $30 billion OpenAI investment might be his last.
Yeah.
Now, did you see that and think, okay, is Jensen saying, well, Sam Altman, he's taking this company public, so of course, or is it a pivot? Jensen's like, maybe I'm going to get more neutral here in the AI game. What did you think?
It's okay. So it's very interesting, just because the original investment was $100 billion. Right? That was the idea. $100 billion. I can't remember how many gigawatts they were supposed to be rolling out. It was supposed to start in this year or next year, where they would send the first gigawatt. I think one of the things, though, is that as NVIDIA was saying, we'll invest $100 billion, Anthropic was over here saying, hey, AMD, we'd like to talk to you. Hey, other companies, we'd like to build our own chips. And so you have NVIDIA saying, well, you get $100 billion. And then they turn around, they're saying, wait, you're hanging out with those guys too? It's like, we had plans on Saturday. What are you doing? So, I think it's very interesting that you have that kind of, we're not going to do 100 billion now. We'll do 30. And yeah, the company's supposed to go public at some point. And how much more can you invest before they start, entering the public market? And so for NVIDIA, it does seem like the right move at the right time. They've also, by the way, been investing across the board in various companies. It seems like every day you get some kind of announcement that NVIDIA is investing. They have the free cash flow, they have the revenue
spread
coming
it
in.
Around in a lot of places.
Right,
yeah.
and so that's to me what they're thinking is okay, OpenAI, it is kind of the name in AI, regardless of whether its model is at the top right now. And that's just going to be something that we're going to constantly deal with is, well, this is better than that, this is better than that, this is better than that. It's never going to be one permanently at the top, at least for the time being. But I think that, them saying, okay, we'll start working with other companies as well and trying to spread our wealth to benefit us more seems to make sense.
Finally, since we're talking OpenAI, here's another one. Sam Altman taking digs at Anthropic. Per CNBC, he was at this Morgan Stanley conference saying it's bad for society if companies start abandoning their commitment to the democratic process because some people, he says, don't like the person or people currently in charge. Altman saying, here's your quote, the government is supposed to be more powerful than private companies, and this, of course, is coming after Anthropic's big feud with the Pentagon over how they can use Anthropic's AI models. What do you make of that one?
It's great because you keep having this back and forth between Anthropic and OpenAI, and we had the
gift
picture
that keeps
of
on coming.
the hand holding thing that never happened.
So awkward.
Dueling Super Bowl ads. You had
Which got personal. I mean, let's be honest.
Yes. Sam Altman came out and kind of copped to their deal with the DoD, seeming kind of ham-fisted when they announced it right after Anthropic said we're taking a moral stance here, and then Sam Altman saying we have to go back and work on the language of the deal after that. So it is, and that's the crux of this argument between the DoD and Anthropic is, does this private company, potentially public at some point, but still just a company, have the right to say to a government that's elected by the people what it can do? Right?
When it comes to national security.
Right.
Yeah.
And when it comes to its own technologies.
Yeah.
Right. And so, I think that's going to continue to be a very divisive issue, especially with AI. It's not as though technology hasn't been used or the government hasn't used technology to mass surveil the American people before. I mean, that came out obviously with Snowden and everything. There's different ways that the government can use publicly available information to kind of locate where people are using ad networks. We saw reports on that recently. And so, with AI making it easier to kind of control different sets of tools, this clearly becomes a much deeper conversation than just, Sam Altman and Dario Amati kind of being not best friends anymore. It becomes a greater conversation as to where does the government's power start and a company's power end, and vice versa. And I think that's going to be a policy decision that the Trump administration and other administrations are going to have to make as we go forward, just because AI isn't going anywhere anytime soon. It's just going to continue to move its way into different areas of the government and business.
And that includes defense, too. Dan, great to see you as always. Thank you, my friend. Coming up, we take a look at Robinhood's newest credit card. Stay tuned. Now time for some trending stories here. Robinhood is jumping into the credit card market with its new premium rewards credit card known as the Robinhood Platinum Card. Yahoo Finance's Brooke DePalma and Inez Frey both here to discuss. Brooke, what do we know about this card?
So this card is going to come at an annual fee of about $695. It was announced last night at Robinhood's Take Flight conference that they had, and also has some pretty cool perks, similar to what maybe a Platinum card has.
Like what? What do I get for this?
All right, so what do you get for it is an Amazon One medical partnership, or membership rather. Also similar to what we see with the IMAX Platinum card, a Oura Ring subscription. You guys know the Oura Ring?
Sure.
Very popular. It's like the wearable ring that tracks everything that an Apple Watch does. Also, you get a $200 annual credit for other health wearable products. So think like a Garmin watch or an Apple Watch. That's certainly a perk catering to maybe a younger customer as well. You get complimentary Robinhood Gold membership, unlimited Priority Pass, airport membership, a $250 annual DoorDash credit, and a $250 annual credit for autonomous rides. Wow. I know Inez is in on that.
Yeah, what do you think? $695 annual fee, Inez, but did the perks sell it? Do you think, you know what, that's worth it?
Well, look, they're going after that premium customer there. I mean, they're going after the high end, but they also have so many other offerings. They've got the gold card. Yes. They have been on this tear of putting out offerings of different products, this velocity of products that they're putting out there. Banking, anything to do with...
Vlad is saying, I'm going to be the one-stop shop.
And that's what they want to be, yeah. And I did get to speak to one of the Robinhood executives, and what they did say was that they want to raise the bar for what a premium credit card experience could be, what it looks like. I even asked, will there be an airport lounge soon? And they didn't totally strike out that answer.
But when you talk to them, Brooke, and you said, what's going to differentiate you? To Inez's point, there's a lot of competing cards. What makes them different?
I mean, this autonomous rides offering is kind of different. I don't see any other cards doing that. And when you think about the price point and how this sort of sits in the set of other premium cards out there, the Platinum card, the Chase Sapphire Reserve card, the Venture X card, it sits maybe in a sweet spot below the Sapphire Reserve, below the Amex, but above that Capital One card that's really known for travel perks.
Autonomous rides, Inez.
This is a company that is looking towards the future.
Yeah.
And they are saying, we are going to be everything that has to do with your entire financial world. We're going to have the entire ecosystem, because they've got family offerings as well, as far as being able for the households to be able to do all of their finances.
Right.
They're looking at the wealth transfer. Most of their customers are millennials. And so when you think about their parents that are then going to, as they pass away, leave their wealth to their children, then you're also looking at that entire wealth transfer that they are saying is going to be their tailwind. And they want to go into those Trump accounts as well. They want to have those. So start from very early, take the entire family, and be the entire ecosystem for your financial world.
Well, speaking of children, I'm sorry, Brooke, go ahead.
No, I was going to say the stock down, though, about 3% as we make our way towards the close.
But it started out in the green this morning. I mean, that's part of, I think, the market rollover. But the market wanted it to go up earlier.
Talking about a different multi-billion-dollar industry now, let's talk about the beauty market. This one, Inez, all right, so the Journal had this great story, okay? We both have young daughters. This is how 6-year-olds want makeup, and brands are cashing in. They are, according to the Journal, selling kids lip gloss, skincare, eyeshadow. The growing business of kids' beauty, they say, comes as Gen Alpha. I didn't know what Gen.
I don't know.
Gen Alpha's your age. Your kids'
Children
age.
born after 2010 become serious consumers. They do have about $3,400 each to spend annually.
I was surprised to see that. That's what the Wall Street Journal reported.
Listen,
They have your money to spend annually.
Yes, they have my money. And I can see this happening because when I walked into a beauty store in Madrid, okay, my daughter goes straight to her line of eyesight, and it's this down below, these little things that look like little toys milkshake. You open it up and it's a little lip gloss. Of course I had to get it for her.
Of course.
But this is how, this is how they sort of start you. And they're looking at...
Yeah, you could have drawn the line, Inez, and some parents do, by the way. This is, and the Journal actually includes this, which I thought was a good report. Some parents don't like this. They say, you know what, it's too young. It's too young to expose them to it.
I know, but they're
exposed anyway.
They're up against the entire world of Instagram and showing your face and everything else. And I'm not saying that I'm going to take my daughter down that road, but I will say that it's hard, it's difficult because they see it everywhere, and even their toys, the toys that show little nail polishes, it's little plastic nail polish. This is what they're growing up with.
Yeah, absolutely. And also too, think about like what I grew up with, at least, like lip smackers were so big, and now to see them not even mention in the Wall Street Journal article.
What is a lip smacker?
You don't know about lip smacker
No.
chapstick, and they had all the fun little lip glosses. I mean, that's what I grew up in. And so I feel like this is something that always has been going on, but because of the very large attention that Sephora got a few years ago for the influx of younger people going to their store, now we're seeing all these new names really jump in revenue. I mean, some of the names you're seeing on the screen have made millions off of this sort of product. Even Shay Mitchell, who's behind Base, and she's an actress, and she even has a young daughter, and now she's a skincare line as well. She is getting somewhat of pushback, but it's just interesting to see celebrities even jump on this bandwagon.
I was at Sephora, Inez, because my 6-year-old, I mean, she can't get enough of this, right? So went to the mall with her on Sunday. She made a beeline for Sephora. It was jam-packed. And she loaded up on like $70 in no time.
Oh, no time.
Nothing.
Yeah, they give you a
One
little
product.
basket. You just put it in.
And you just go, yeah.
And the thing is the packaging. The packaging has gotten very clever because it is
Colorful.
catchy, colorful, unique, different shapes. So it's a huge industry. And
Also, maybe the price point a little lower as well to sort of cater. Maybe, I mean, I hope that some kids, maybe they're making some allowance.
Yeah.
And so this is what they're spending their money
Well,
on.
you got to know the price point to get, though. I was reprimanded by my wife when I got home. She said, "What are you doing spending $70? This is like top line stuff." And I was like, "Why would you assume I would know what brands to get?" Yeah.
So what kind do you even remember?
Oh, we'll be back next Sunday. We'll spend even more.
Look, the more that people spend time on their screens and via Zoom and everything else, this is what they're growing up with. And so they are all looking at their faces.
Yeah, and
the
people even
product
maybe
for that.
at school, they're seeing other kids come in with the lip gloss. They want it too, and it definitely is a growing market. Even I interviewed the diaper company Coterie, and they actually came out with skincare. So you think about like Honest, Coterie. We're just getting younger and younger, guys.
Yeah, all right.
Or we're getting older and older.
Yeah. A lot of shout out to Sephora. Man, that place was hopping. Impressive. Thank you both. Appreciate it. Coming up, we look at PayPal and Upstart stocks in our latest edition of A Good Buy or Goodbye. Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves to your portfolio. I'm here today with Cameron Ansari, venture partner at Infinity Ventures. Cameron, always great to see you. Let's start off with one name you like, and this would be PayPal. Now, this one's interesting, Cameron. It's down about 30% over the past 12 months. Most analysts, Cameron, who are paid to tell you what to do with this thing, most of those men and women tell their clients, you know what, this one's a hold. I think per Bloomberg, like nearly 70% are on the sidelines. You say, you know what, you disagree. You say it's a buy. Let's go for the chief reason, strong financials. Why is that a reason?
Sure. Look, I mean, PayPal, this is a business that throws off $6-7 billion of free cash, growing to probably $8 to $10 billion of free cash in the next couple of years. You know, I haven't run a discounted cash flow in a little while, but I can tell you right now that this business is probably worth more than $40 billion where it's trading now, just because of the cash flow alone. Strong financials. It's a solid, single-digit grower. It's not growing 50% a year, but it's a stable business that's not going anywhere.
All right. Second reason you would commit capital, stock is undervalued, you say.
Absolutely. I mean, it's gotten crushed, as you saw in the last week or two, and then over the course of the last year. And this is a stock that's trading at a significant discount to peers, and even not only its peers, but also its historical averages. And there's talk of maybe it's going to get bought or acquired, and so there's a sentiment around it that I think is negative. There's talk of maybe Stripe buying, and the Stripe says they don't want to buy it. I hope that doesn't happen because honestly,
why? Why do you say that?
Because you don't want Big and Tupac coming together, right? It's like two very different companies, cultures, styles, and for the sake of consumer and merchant choice, I hope that doesn't happen.
All right, third reason. So valuation's attractive, you argue. Third reason, two-sided network.
This is a sticky business. They have 35 million merchant relationships, over 400 million consumer accounts. Again, these aren't going anywhere, right? Those merchant relationships are very sticky. They're integrated at point of sale. When you see that PayPal button on a merchant site, that's there. Behind that is a bunch of bank integrations and rails. So for that reason, I think this is a stable business. It's not going anywhere, and it's just been, I think, undervalued because of sentiment.
All right, you've made your case, as always, Cameron, very eloquently, convincingly. Before folks pile in, though, what is the risk they need to think about?
The stock market oftentimes acts just like a kind of mass voting machine, and I think the sentiment has really turned on this stock and this name. And the primary reason is, I think, a lot of management turnover. So a lot of the folks that had built the business, a lot of the folks that I worked with at Venmo and Braintree, they've moved on, right? And Dan Schulman, who ran the business for a number of years, has moved on. And now they're going to change CEOs again. They're bringing someone in from Hewlett-Packard.
Enrique Lores.
There's a sense that maybe, is a guy from sort of the hardware, computer world, the right person.
What did you make of that pick?
It's an interesting choice. I don't know if it's the right fit, but certainly they need change. And I think they need executive leadership. And ideally, if I'm a shareholder, I want people from the payments business.
All right. So that's one you like. You like PayPal. Now let's get to one you would avoid. That would be Upstart. This stock has been crushed already. I mean, we're down about 50% over the past 12 months. You say, a lot of times folks will look at a chart like this. They'll say, listen, the bad news just has to be in.
It's already happened.
You say, no. You say, you know what? I would keep avoiding it. Let's go through the reasons why. First one, AI regulatory risks.
Yeah, I mean, look, from an AI perspective, in fact, it's not just regulatory. Both analysts and investors, as well as the regulators, are skeptical here. The analysts are skeptical because they think the AI models that Upstart uses to do the lending can overcorrect, can lead to poor performance, can lead to biases. The regulators are concerned because, again, they think the AI models that are used to lend could lead to prejudice, could lead to performance issues that they don't want. And so there's a sense that they may come in and try to regulate the way that not just Upstart, but anyone who's using AI to do underwriting and lending behaves. I think that's the overall kind of gestalt risk on this business.
Second reason to avoid, you say, macroeconomic issues?
It's not good news for the U.S. consumer, but we're seeing higher delinquencies, higher amounts of consumer debt overall in the U.S. There was a report this week from both Vanguard and Alight that they had record numbers of withdrawals for hardship from those investment accounts, the 401ks.
I saw that, yeah.
So, as a result of all that, I think this is a tough business, potentially macroeconomically, particularly compared to other competitors that are larger and more well-financed.
Final reason you say avoid this one, funding balance sheet risks.
Right, related to number two, I mean, this business, the way that consumer lending works for a business like this, market cap's like $2.5 billion, is that they then sell their loans downstream to other folks, or they use larger warehouse facilities and banks and private credit companies to provide them with the capital they need to lend. And if the performance doesn't match up with what they want, then those really dry up, and that's a big risk for this business.
All right, we'll end here quickly, Cameron. How could you be wrong on this one?
Well, they have a quarterly earnings coming out for Q2. If they crush the numbers, if they show that, listen, you guys were all skeptics for reasons that were incorrect, we have great performance, low delinquencies, low defaults, then I think that may change the narrative a little bit.
All right, buy PayPal, avoid Upstart. Cameron, thank you as always, sir. Appreciate it. And thank you all for watching. Goodbye or goodbye. We're wrapping up today's Market Domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. Hello and welcome to Market Domination Overtime. Stocks closing deep in the red here, failing to build on a rebound session. Let's get to Yahoo Finance's Jared Blickley with market action. Jared.
Thank you, Josh. Let's take a look at the Dow here. Only a few minutes ago, I was calculating we were on track to wipe out all of 2026 gains. We're pretty close, so I got to check the numbers, but that might have been the case. Any way you cut it, the worst day in about 6 weeks for the Dow Jones Industrial Average, down about 785 points. Here's a NASDAQ Composite. You can see nice rally off of the lows, but still closing the day down about 1/4%. And the S&P 500, I have been watching the 6,800 level like a hawk, and we dipped below it several times this week, but we managed to close above it. So that's kind of where things tilt for me in the risk-off direction. They kind of accelerate, but we have not reached that point yet. Meanwhile, Russell 2000 small caps not looking very good. They're the weakest of all these markets we've tracked so far, down 2%. And do want to show you the Dow Jones transports. Those were down even more, down 3%. So let's take a look at the large cap sector action. Here we have energy. in the green here for about 0.5%. Then tech and consumer discretionary, the Mag 7, some of those big stocks, kind of a bastion of strength today, although not a lot of winners in the sectors. Here's industrials down 2.2%, materials down 2%, so is staples, healthcare right there. All of these have charts where they're looking like technical breakdowns took place today, so not looking very strong on those daily charts. Here's the NASDAQ 100, and you do see some strength in those big companies. Here's Broadcom up almost 5% after that earnings announcement earlier this week. Microsoft up 1%, Amazon almost 1%, Nvidia just barely positive. But check this out. Here's the Dow Jones Industrials. Industrials themselves as a sector were just kind of decimated today. But in other sector news, here's Staples, Walmart down 3.5%. Here's financials, Goldman Sachs down 3.5%. United Health, Merck down 2.5%. So not a lot of strength to be found in this market. And let's take a look at the defense sector. This is something I was eyeballing because it was a go-to kind of defensive play, kind of a pun there. But you can see there's a lot of red on this board right here. Even in energy, although we did manage to close in the green for that sector, you're seeing a lot of red. And by the way, crude oil north of $80, that's another key level. That kind of changes the macro landscape and suggests that we might be seeing a little bit more inflation than the Fed would like, or anybody for that matter. So I'm going to close on the transports, and here you can see there's that sea of red. Airlines doing pretty poorly, United down 5%, and some of the shipping companies like the railroads that were doing well earlier, CSX down almost 4%, UPS down almost 6%. So list goes on, but just kind of a risk-off day. Nevertheless, that critical level in the S&P 500, 6,800, did manage to hold into the close.
All right. Thank you, Jared. Appreciate it. With U.S. markets once again ending down in the red, investors assessing the long-term impacts of conflict in the Middle East. Let's bring in now Christian Chan. He is AssetMark's Chief Investment Officer. Christian, it's great to see you. So you make sort of an interesting distinction here, Christian, talking about kind of short-term geopolitical shocks versus what you refer to as longer-lasting regime-type conflicts. Based on what we know so far, Christian, with this war with Iran, what category do you think we're falling into here? And what are the signs and signals you would use, Christian, to kind of determine that call?
Yeah, thanks for having me, Josh. Great to see you again. In our mind, again, we do draw the distinction between the difference between a shorter term shock, similar to what we saw in Venezuela earlier this year, and then a longer term regime oriented shock, which is more akin to what we saw or what we're seeing in Russia and Ukraine. This time around, I think it is too early to tell, unfortunately. But what makes the situation more complex, of course, is oil prices, the Strait of Hormuz, and then how, of course, higher oil prices percolate throughout the economy. And I think what the markets are struggling with today, and we saw this with the S&P holding certain technical levels as we just saw, that I think the markets are holding out hope that will be in the former shock, type of shock, a shorter term shock, which is something that we're all hoping for, of course. What we're looking for is primarily how the operation is progressing versus the late expectations from administration. Some of those are moving around a bit, but that's the main thing that we're kind of keeping a track on. If you're looking at signals, is how is the actual operation progressing versus the expectations that the administration is setting.
I had an economist on the show today, Christian. I was kind of getting at the same question with her in terms of, all right, how does she sort of gauge whether we've moved from short-term shock to something maybe more long-term lasting, a bigger long-term impact on the economy? And through her prism, she says she's, of course, very focused on oil. And I asked her what levels she's watching, and she said, I'm going to be watching oil. If we hit 100, she told me, and then we stick there for a period, that would be a concern. I'm just wondering, is that also the metric that's on your radar?
Yeah, I think she actually nailed two elements I think are important to think about. First, what is the level? And then secondly, how long it stays there. So a $90 level for an extended period of time could be as damaging as a $100 level for a shorter period of time. And that's exactly what we're looking at, because as you know, oil impacts the U.S. economy, in a few different ways, even though we're much less sensitive to oil than we were maybe 20 or 30 years ago. But inflation expectations, to me, is the big one that we're looking at. Over the last month, inflation expectations are up almost 30 basis points. Now, part of this is because of inflation building up in the pipeline, but part of this is due to the recent run-up that we've seen in oil prices.
You talk about this broader market rotation too, Christian, away from mega cap tech, talking about toward energy, industrials, materials, even small caps. Temporary rotation, Christian, or no? You think maybe something more structural is going on here?
I think these rotations have some legs to them, and a lot of what I look at is, all the market concentration that we see today within the Mag 7, within big technology spends, AI. Some of those are so far off in the future, they feel like they're a bit nebulous. And I think what markets are reacting to is, one, this different phase of the AI spending cycle that we've entered, but two, this rotation into things that feel a bit more tangible. So asset light to asset heavy is another one that we focus on. But what I think is interesting is that when we typically see these massive rotations in the marketplace, we also typically see steeper drawdowns, we see higher volatility. And so far, we've seen markets move mostly sideways over the last 4 months.
Where's the Fed in all this, Christian? Where's the Fed in sort of your investment outlook?
Sorry, could you repeat that?
The Fed, Christian. I'm curious how the central bankers kind of fit into your investment outlook.
Yeah, so we still expect an easing outlook in 2026, and the markets, largely because of this increase in inflation expectations, have basically trimmed one cut off of 2026 expectations. So I think that still keeps us in what I would consider to be an easing mentality. But certainly, if we see inflation north of 3% and heading higher, I think it'll be challenging for the Fed to continue that cutting cycle.
Final question, Christian. Just curious to get your take. That jobs report tomorrow. What are you expecting? How important is that for the market?
I think it's really important. One of the reasons why I think we haven't traded off more, given the conflict in Iran, is that we've had a, generally speaking, pretty, I'd say, healthy outlook in the U.S. economy with all of these metrics that are coming in. You can talk about the consumer, you can talk about the ISM indexes, both being in positive territory as indicators that there's a lot of underlying strength in the economy. Now, if we get a negative jobs number or something that is far off of expectations, I think that changes, of course. So I do think this is an important number, as all jobs numbers are. We do feel like it'll be an okay number just because we've seen continuing claims numbers. We saw initial claims earlier this week that suggests that the mass layoffs that we're kind of all worried about when it comes to AI and kind of the implications there, so far those have come in okay.
Christian, as always, great to have you on the show. Thank you. Coming up, tax season is here, and we're speaking to an expert to help clear up all your questions about tax write-offs. That's next on Market Domination Overtime. We all spend a good amount on our phones and tech subscriptions every month, but could those bills offer you some relief on your tax bill? Join me now as part of our Write It Off or Nice Try segment presented by H&R Block is Misty Erickson, National Association of Tax Professionals Program Manager of Tax Content. Let's start right there, because I'm sure that's probably pretty top of mind. Can I write off my Wi-Fi bill?
It depends. And I wish there was a yes or no answer for every scenario. But what are you using it for? Is your Wi-Fi used personally? Your kids are using it to game? You're using it to stream TV? Any of those answers lend it to personal use. Now let's flip the script. Now, what if you have a business or a home office and you're using your Wi-Fi to do business-related work? Now that changes the dynamics. Does it mean it's 100% write-offable? No. You're going to have to look at an allocation or really that percentage of business use versus personal. Now change those facts even more. What if you have a separate business location that has Wi-Fi? Now you're looking at potentially fully deductible. If there's no personal use, yes, that's a write-off.
All right, so it can get complicated. How about this one? My cell phone payment, Misty. Can I write that one off?
Same kind of boat as your Wi-Fi. What are you using it for? If I have a personal cell phone, I'm not doing any business expenses. No, it's not. It's a personal non-deductible expense. And yes, that is IRS terms, personal non-deductible, right? But again, what if I'm a business owner and I only have one cell phone? Well, in that case, again, you're looking at how much did you use it for your business? Use a percentage, do an allocation, and then you can take the deduction. Now, if you perhaps have two cell phones, one strictly for business, now you're looking at 100% business use. You don't have to do the allocation, and you can just write it off.
How about this one? So I'm in media, obviously, right, Misty? So you got to keep up to date. News, content, right, part of the gig. Can I write off my streaming services?
What are you using it for? If you're doing research, yes. But if you have, you're streaming Paramount Plus and you're using it to watch movies or the latest shows, then no. And again, this is one, I feel like I'm repeating myself, but it boils down to what are you using it for? If it is strictly personal, nice try. But if you can actually say, you know what, I spend a large chunk of my time, I am, watching CNN or other news shows or Yahoo Finance, whatever it may be, in that case, then yes, if you're doing that research for your job. But if it's for fun, again, it becomes personal.
All right, this next one, this is, I'm sure on a lot of people's radar, increasingly, AI chatbot subscriptions. What do you think, Misty?
So I'm in the content world, right? Say if I decided I wanted to freelance, yeah, potentially. Am I using it to help me generate content? Then some of that could be deductible. Now, if you are using it to say, hey, help me fine tune this recipe, well, that's personal. Unless hey, do you have a cooking show? Maybe. So you're really looking at, again, that use. What are you doing it for? Is it really related to a trade or business, something that generates you income? You're trying to have a profit motive versus, no, this is really what I do in my personal time, not really related to, again, that trade or business in that concept.
Any final tips you can give our viewers on tax write-off, Misty?
Really, you're looking at what are you using it for, and be honest with the what and the primary purpose of why you're doing it. Also looking at, is it ordinary and necessary in that business? And now when we're dealing with different industries popping up, that question can be harder to answer because maybe there isn't a lot of history on what means ordinary or necessary in that field. So then you're looking at it, does it make sense for what I'm doing? Yes or no? And then, is it necessary to do my job? And if you can answer yes to both, then yeah, you can make an argument on why it's business purpose. The other flip side of it too, I think, especially when we're looking at more people working remotely, your remote job, that doesn't qualify. So I work from home, I would say 90% of the time. That doesn't change my Wi-Fi from now a deductible expense because that's considered that unreimbursed employee business expense, which that's gone away and hasn't been around since 2017. And that provision was made permanent, so we know it's not coming back unless if something changes.
It gets complicated. That's why we appreciate all that insight and advice. Thank you, Misty.
Thank you.
Broadcom shares rising as the CEO says AI chip sales could top $100 billion in 2027. Bernstein analyst Stacy Rasgon joined Market Catalyst this morning with Julie Hyman to discuss the chip maker.
Well, Stacy, it's great to see you. So I know that you thought that this was quite a quarter and quite a call as well. Line them up and knock them down. That was the title of your report. Reacting to this, I want to start with that $100 billion number, right? Because,
but by the way, it's $100 billion in AI chips, not chips.
Oh, I thought he said it was chips. I thought he specified it was chips overall, but no, it was just AI chips.
But it's AI chips overall.
Gotcha. Okay. Yeah. I mean, like, it's almost like we're a little blasé about these huge numbers at this point. So put this in context for us, both just for Broadcom and for the industry, how significant that number is.
Yeah, you bet. So you got to remember, so there were a few, the stocks have been through the ringer since its last print. Their last print was pretty good too, but there were worries that people had. The stock was down 20% since then, and I think one of the issues was they had put out this order number last quarter. They said like 73 billion in orders over the next 18 months. And as big as that number is, people sort of thought it was a little underwhelming at the time, I suppose. And so they're kind of putting a stake in the ground now. And they basically said close to 10 gigawatts in shipments next year to a variety of customers, Google, Meta, Anthropic, OpenAI. And significantly more than $100 billion in chip revenues. The 10 gigawatt number to me suggests more than $100 billion, but I'd say that was a number that was well above sell side consensus. I think it's in the range of some of the more bullish buy side numbers at the time, and it's giving people a lot more comfort, I think, to underwrite the trajectory from where we are now. We're starting to see the inflection into a really big number as we go next year, and so. You have to remember also, Broadcom's lead time, the lead times are pretty long. They've got pretty good visibility. They've got orders in place. They're putting the inventory in place to support this. They have the supply to support it. It's looking more and more real, I think.
I got to ask you about margins. And especially because Hock Tan, nothing less than a colorful character always. One of your peers on the street asked him a question about rack sales, the effect that they would have on margins. And he said, I hate to tell you that you must be a bit hallucinating. And he basically said, margins are solid, they are fine, this is not a problem. Yeah. Was that a convincing pushback for you?
I think so. So, yeah, Hawk can be colorful. I think he called, on one of the calls a couple of quarters ago, he called my analysis defective. So, he can be a little colorful sometimes. It's kind of a badge of honor, maybe. So there was a worry. So a lot of they've got, tens of billions of dollars of Anthropic revenue coming in the second half. That revenue, however, at least at this point in time, is coming in the forms of racks. It's actual server racks, which tend to carry lower gross margins. And people were very worried, us included, that it was going to be dilutive. Our gross margin profile going into the print kind of looked like this. I had an air pocket. And so that has been an increasing concern for investors, even though, frankly, it's not really fundamental. It's not like it's low margin because it's bad business or they're cutting prices. Just racks tend to have more commoditized components to them, which tend to have lower gross margins. But he said, "Don't worry about it. We got it."
And is that the case, or
from Hawk? I think that's enough. They used to there used to be a saying way back in the days, in Hawk we trust. But I try not to get too enamored of my management teams when they're just pontificating. You don't always want to trust. Just flat out trust management teams. Hawk's credibility in general has been pretty good. And if he's suggesting that he thinks he can keep gross margins, in a good place, even as the racks ramp, I think we believe him. So he kind of took that off the table as well. That was another thing he knocked down.
There's something I have to ask you, though, related to that, which is that Anthropic is a large customer. Is there any chance that revenue is in jeopardy because of the whole fallout from the Anthropic Pentagon supply chain ruling situation?
Yeah, who knows, right? Doesn't seem like either Anthropic or their suppliers is thinking that there's like a material change. I know, if it was just the government revenue itself, it doesn't look like it's that big. Now I know the government had said like don't do any business with them. I'm not sure how legal that is. That's out of my realm of expertise.
Yeah.
But it doesn't look like at this point anybody is terribly worried. I guess we'll just have to find out. And frankly, with this administration, like things can change pretty rapidly.
Yes, indeed they can.
So I'm not ready to underwrite any proclamations out of the Trump administration at this point.
Also on Broadcom, I mean, it is a chip maker, but it does a lot of other stuff also, right? And I'm curious about those other businesses and how they've been performing, because it's, we think of it in the same bucket as some of the other chip makers, but again, it has these other business lines.
Yeah, so they got AI chips, which are great. They've got non-AI chips, which frankly have not been so great. They've kind of stabilized for the last year or two, but their non-AI business is probably down, I don't even know, 30% off the peak. They're not the only ones in that bucket, by the way, but the non-AI chip business has not been super off of those COVID peaks. But it has stabilized, and they're kind of guiding that piece of it flattish next quarter, which is fine. And then they have a software business. Software's been really good. They bought three or four companies over the last year. They bought CA Technology, which does mainframe software. They bought Symantec, which does enterprise security, and the biggest piece is VMware, which does virtualization. And in fact, this has been another controversy. Investors have been just jettisoning software, on fears of AI disruption. And I do think like the Broadcom narrative had been caught up on that. They've got a $30 billion software business. The thing is, they address this on the calls. It's not, they don't do anything at the application layer. They don't do anything in middleware. It's all infrastructure. Like AI, in fact, on their VMware, it's actually running on VMware. I do not think that their software business is really at risk from AI disruption. They kind of articulated that view as well.
Gotcha.
And it's super high margin. That's the other thing. Like they don't really run it to grow it like massively over the long term. They're comfortable with like modest growth, but they run the thing, at like, where was the last quarter, 78% operating margin or something like that. Wow. It's just a massive cash machine for them. It's been going very well.
Stacey, you mentioned what's been happening with some of these chip stocks year to date, and then I'm looking inside the stocks, and of course we have Nvidia down, Broadcom itself down, AMD's down, Qualcomm's down. What causes a reversal of that? What causes a reinflection of these stocks or does anything?
Well, the SOX is actually, the steady index is actually up over 10% year to date. So,
right.
But you're right, there's been big divergences. So we've had some of the compute names, the Nvidias and the Broadcoms of the world that they've been sort of stagnant, right? We've had the Qualcomms, anything in the smartphone space hasn't been so great. People worried about memory prices going up and the like. But on the other side, we've had some massive moves, mostly in the AI constraints, memory, semi-cap, optical, all these things, and these things have just ripped, right? Yeah. And in fact, there's a very interesting divergence going because you have all of these like AI things, again, the constraints, the components that are ripping. You have the AI compute names like the Nvidias and the Broadcoms that have been more stagnant, right? And you look at this and you say, well, what's going on? Because I have all these names running. Why? Because they're going to build all this great AI stuff, which is fine, but like, for who? Who are they going to build it for? Presumably they're going to build it for the Nvidias and the Broadcoms of the world that have not been moving. And so there's an increasing divergence that is getting very interesting. And like one of them is wrong, right?
Right.
I personally don't think that is sustainable. I think it has to normalize like one way or the other. And given what we're seeing out of the compute names, I'm liking those plays right now.
So in other words, maybe one of them isn't wrong per se, but maybe they just need to sort of like, one needs to come down a little bit, the other ones need to come up a little bit.
The valuations are not consistent with each other. Let's just put them in. So in some way, either they come down or the others come up, I think. But I think it has to normalize somehow.
Yeah. Stacey, it's always great to chat with you. Thanks so much. I appreciate it.
You bet.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. A new report from Challenger showing layoffs dropped sharply in February, but hiring plans remain weak. For more, we're bringing in now Andy Challenger. He is Senior VP at Challenger Gray and Christmas Inc. Andy, it's great to see you. So let's talk about your recent data. One big number that jumps off here. Layoffs dropped 55% in February. Now that sounds positive, although listen, I get it, it's one data point in time, but what did you make of that number?
Yeah, that was a good number. We want to see those layoff numbers coming down, right? The whole world is watching U.S. labor markets to see if this 2-year period of gradual cooling in the labor market is ending up with a nice soft landing like the Fed had intended, or if we start to see things accelerate downwards, that would say maybe they overcorrected and we're going into a recession.
So you say layoffs fell, but you guys also point out companies are planning, it looks like, to far fewer hires this year. Why is that, Andy? I mean, is that just, what's that telling you, I guess, about business confidence?
Yeah, that's exactly what it's about. Yeah. There's a lot of uncertainty when we see the low number of announcements that companies are making around what they plan to do for the year with their employees in terms of hiring. It's a sign that they don't have a good sense of it, that they are feeling a lot of uncertainty, whether it's market conditions or geopolitical conditions. There's enough going on right now where companies are just kind of staying pat.
So do you think, Andy, bring in kind of a crystal ball here, is that trend of kind of just what we're talking about, sort of low fire, low hire, you think that persists?
We will see, right? That's, everybody's looking at it. We're seeing if it'll slow down and just kind of stay where it is. There is a lot of worry, though, that we're also sitting on some type of AI job apocalypse cliff. And so every time we see a company announce layoffs right now, directly attributed to AI, which
now, do you always buy that, Andy? Do you? I mean, that's the trick. Is like they'll say that, but sometimes these companies have their own problems.
And I've been pretty skeptical about it for at least a year.
I mean, a company will say it's AI, and then you pull up, Andy, like a 5-year stock chart of that company, and it's like, it's a disaster. I mean, you just wonder is it just AI, I guess. To your point, though, we should mention, I mean, in your data, you have a good stat here. AI was cited in about 10% of February layoffs.
Which is surprising. We've started to see that come up last year. It was about 5%. This year, it's coming up a little. So as we start to see that happen more and more, the story starts to become a little bit more believable.
Digging into sectors, too, because I thought some of this data from you all was interesting. Technology announced about 11,000 job cuts in February, so that brings the total to around 33,000 in 2026, and that's an increase, you all point out, of around 50% from the same period last year. What do you think's going on there? What are some of the dynamics in play? AI or something else?
Unfortunately, probably is AI on some level, or at least that's what they're saying. There's also this dynamic where during the few years of COVID where they hired like crazy, they've had to now start to come back down to earth. So we've actually seen technology being a leading sector for job layoff announcements for the last 3 years.
What about such tech? What about manufacturing? I asked there because obviously that's a priority for this administration. I mean, granted, relatively early days still, but what's going on there in that sector?
Yeah, throughout the year of 2025, we saw overall employment in manufacturing fall slightly. It didn't change that much, but it certainly hasn't been a positive story. And we've actually started to see this year a couple announcements from companies in the industrial goods sector, specifically around engineering, aerospace, Boeing, a couple big organizations that have announced they're going to probably cut this year.
What about geopolitics? You mentioned that, right? War with Iran, we're all focused on it. What kind of impact could that have on hiring and business confidence? Or do you think, it's just too soon to say still?
It's too soon to say yet, but the big contributing factor is going to be oil. If it starts to shoot the price of oil as a commodity up through the roof, that'll affect certain sectors more than others that really rely on that as a core input.
What about the big government jobs report tomorrow? What do you think? Any expectations?
Yeah, I'm not expecting a particularly positive report. We saw a good one last month in January, over 100,000 jobs added as kind of a surprise. My expectation will be significantly lower this month, but it could always surprise to the upside. We're in this moment where we really don't know which way things are headed. We've been on this slow cooling of the labor market.
That's sort of been the mantra, right?
Yes.
The theme has been, I mean, how many economists have come out and said, cooling, not crashing. That's been how they've described it.
And it's what their aim is. The Fed has made a priority to cool down the economy through interest rates slowly and gently without crashing it. Now's the whole world's looking at U.S. labor market to see if they pulled it off.
Andy, so great to see you, especially on set. Thank you.
Thanks for having me.
Stick around. Much more asking for a trend that's still to come. Andy, that was The premier motorsports series Formula One is entering uncharted territory in the new season. The high-performance athletes are buckling up for what is a key stepping stone for the sport. Yahoo Finance's Praz Sumeranian joins you now with a closer look. All right, Praz, so Formula One, big changes, new rules, new teams, right? They moved from ESPN to Apple TV. Why is that such a big deal for the sport? Is it money, eyeballs? Maybe it's different eyeballs?
Yeah, I mean, you kind of hit it all there, right? So, money is good, obviously. Apple paid reportedly on $150 million a year for the streaming rights for the U.S.
$150 million?
Yeah.
Wow.
For the U.S. And that's actually, compared to other sports, it's not that much.
Yeah.
But it's been growing higher and higher as the sport has seen high uptake and interest in the U.S., right? And then if you're talking about reaching users in all different kinds of areas, Apple's where you go, right? The Apple ecosystem. You have Apple Music, Apple Maps. So music will have like certain special content for F1 fans. The Maps feature, you can actually go to a F1 track and you can walk the track, and it has like it put special information on the map, and it's in high res detail, stuff like that. So and then we also have stuff like the Netflix cross promotion deal. We'll talk about later.
Yep.
Even Yahoo Sports, our partner, Yahoo Sports, is going to be doing live qualification and practices on Yahoo Finance, because Apple is seeding it out, not just on Apple TV, but everywhere.
So as they make this move from ESPN to Apple TV, you've laid out all the opportunities, right? The upside. What were some of the risks for F1 in this move?
So with ESPN, you have that mass, broader audience, right? You had 1.3 million people a year tune into ESPN to watch the race, right? That's on regular broadcast TV, but also on the ESPN Plus, like their streaming app, right? So you had a lot of big audience there. It's do you lose the casual fan, right? Before you could turn the race on, you watch it on ABC, you watch it on ESPN, you catch them, what's going on here? They get intrigued, and you kind of add more viewers. Now, if you want to watch F1, the actual race, you have to go to Apple TV in the US. You have to go and pay a subscription to get Apple TV to watch those races. You cannot watch those races in the US outside of Apple TV.
So who's going to win this thing? Who's going to be champion? Polymarket, by the way, all right, weighing in, has a bet on who will be the F1 drivers champion for the 2026 season. About 28% see George Russell Praz coming out on top in the driver's standings. Max Verstappen close behind with 21%.
I'm a little surprised by this.
Why?
Well, Russell, he's a good driver, but he's no Max Verstappen. He's no Lewis Hamilton. Lewis Hamilton and Ferrari doing quite well in preseason testing. You can never count out Max. So I think that's interesting. Maybe there's some inside info there. Maybe Mercedes' new vehicle, their new car with new engine, potentially is got a world beater there. So we'll see.
Here's a question. Who is the typical fan of F1? I ask because, like every God-fearing, red-blooded American, I watch the NFL. When I think of F1, I be honest, I kind of think like rich European dudes.
Yeah.
But maybe I'm old. Maybe I'm outdated. Maybe that's not what it is.
I will say this: Lewis Hamilton owns a piece of the Denver Broncos. That's a little cross
there you go.
But traditionally, the sport F1 is an elite global sporting series, right? It's all the rich European guys, like we said. Sorry, European guys, right? But now, since Liberty bought F1, their mandate is this sport is going to grow tremendously. Fans are going to have access to the drivers, to the sport, to the tracks, but we're also going to grow in the U.S., and that's what they did. The big thing they did was they put this special here. This is called Drive to Survive. They put that on Netflix. It's a kind of docu-series about the sport. It hit right before the pandemic, locked us all down. In America, people watched it, they consumed it, they loved it. They want to go to races, they want to watch races, and it took off in America. And that's what we're seeing here now with this big deal with Apple paying the money for it.
One twist you mentioned in your story, which I thought was really interesting, was Apple and Netflix kind of sharing the content. Walk me through that, because that was curious to me. Like, what is the reason for this collaboration? What are they each getting out of this?
This just happened last week. Basically, Netflix is they took that Drive to Survive series, and they're letting Apple show it on Apple TV, the whole series. It's going to be available on both platforms. And then Netflix gets one race, the Canadian Grand Prix. They get to stream that live along with Apple TV. So they're going to get a race, and they're going to get the docuseries on Apple and Netflix. So look, traditional broadcasters would never do this because it's too hard to sort of partition off the rights and you get this and you get that. Apple's like, hey, we can do this.
Yeah.
And then look, Apple and Netflix they're rivals when it comes to streaming, like big time.
100%.
And for them to actually do that is really interesting, and they kind of see the pie maybe growing. Apple says, hey, more people, better for us, better for them. With the docuseries, it's just sort of a new way of thinking about how content is sort of surfaced to people.
Final question: when analysts are writing about this, and you're reading through all that research, like, are they saying, "Hey, this is a smart bet"? Are they thinking this is a misstep disaster? What's the take?
In the latest Formula One earnings call, a Wolf analyst mentioned that some investors were telling him that this was, quote, a disaster.
Why did they say that?
Because it's perception that Apple TV means less distribution because of the loss of ESPN. So that was the concern, and then he asked management about that. But the Wolf analyst himself actually said, we disagree with that take. We think that the Apple deal is not a negative. It's a unique deal. Mentioned the Netflix-Apple sort of partnership there. Would certainly not have happened with legacy platform. Yes, ESPN has more reach, but that Apple can get them in all kinds of places. And also, broadcast was sort of a bad platform because of the fact that race around at 1 a.m., right? You know, like they were rebroadcast later, but it was hard to catch them. Now it's easier, I think, with Apple TV. That's what the analysts are saying.
All right, Pras, thank you, buddy. Appreciate it. And you can check out more from Yahoo Finance's Prediction Markets Hub, powered by Polymarket, by scanning the QR code on your screen. Stick around. Much more Asking for Trends still to come. IMAX is set up for a big year with several huge movies coming out in the next few months. IMAX CEO Richard Gelfond joined Opening Bid with Brian Sozzi this morning to talk about the movie business.
26 is one of the most exciting slates we've ever had. 25 was by far a record for us. A maximum global box office, maximum revenues, maximum EPS, maximum EBITDA, and this year we projected to be better. And the releases driven by, sort of like a who's who. At the top of the list is The Odyssey, Chris Nolan's new epic, which he shot entirely with IMAX cameras. First time that's ever been done, and the cast looks like the reception line at the Oscars. And then we've got Dune 3 this year, directed by Denis Villeneuve, starring Timothée Chalamet and Zendaya. We've got Mandalorian and Grogu, the next in the Star Wars series, directed by Jon Favreau. We've got Toy Story, Super Mario Brothers. Coming up in a couple weeks, we've got Project Hail Mary.
Yeah, I heard you talking about that on the
Yeah, it's Ryan Gosling, and it's from the author of The Martian, and it's I won't give anything away about it, but it's an incredibly sci-fi story and also about friendship and companionship, which is kind of a strange combination.
I've always been jealous that you get these movies in advance. You get to see these things before they come out.
So I'll let you in on a secret. You can't tell anyone.
I don't want to tell anyone.
They're done in advance, but not enough in advance where you could really enjoy. They're always kind of last minute.
You mentioned that movie that was shot using your technology. How, to the average human out there, how does that change the viewing experience for them?
Well, IMAX is the highest capture image platform, image mechanism, and display platform. And when you shoot it with our cameras, you've captured it in a way that no other movies are captured. So our film frame is called 1570, which is kind of the size of the negative. And we just developed a new generation of cameras, which was quiet enough to be able to capture an entire feature-length movie. And Chris Nolan did the first whole movie in this one, Odyssey. So you'll be able to get, close-ups, long shots. A lot of people associate IMAX with, kind of outdoors, nature, vistas, but this is being the Odyssey. That's a story most people know the ending and know the plot line, but you could follow the adventure around the world and, untold beauty.
Are there other movies in the pipeline that will use your technology like this?
Oh yeah, and we shoot digitally or we shoot in film. And this year, I think we have 11 or 12 movies that are shot with our cameras, although the Odyssey is the first one to be shot entirely with our cameras. So many of the ones that I told you about, including Mandalorian, is shot IMAX digital. The Dune 3 is IMAX film, and a lot of the other movies have IMAX DNA. But when you combine the two elements, image capture and image projection, it looks really spectacular. And from a business point of view, when we do it with our cameras end to end, the indexing or percentage of the box office goes up, and therefore market share. So the last number of years, our market share's been increasing, and as I said, last year was a record market share. But also, since you referenced it coming in to the piece, the Academy Awards are coming up soon. So IMAX has had an extraordinary amount to do with this year's Academy Awards. So Warner has 31 nominations for Academy Awards, and every one of those awards was from movies they did with IMAX, including Sinners, including One Battle at a Time, Weapons, and there's more. And of the Best Picture nominees, there are 10 each year that are selected. This year, 5 was shot with IMAX cameras, and Oppenheimer won, which was shot with IMAX camera. So increasingly, it's not just the financial model, but it's also the artistic model, which both consumers prefer and the industry is recognizing more and more.
Rick, this of course comes at a time where you mentioned Warner Brothers. I mean, we're waiting. I mean, this battle for Warner Brothers with Paramount. Netflix appears to be out. You've been doing this for a while. You've seen a lot of media consolidation. What does the future of Hollywood look like? Because there is a lot of concern that this combination is David Allison's going to come in here and he's just going to eviscerate jobs.
Well, I mean, first of all, David has said publicly that he'll make as many movies as he did with the two studios separately, and I know that's the plan, but whenever you put the questions together, what's the future of Hollywood? Anyone who says they know is just over-exaggerating their capabilities. But there's more and more content coming online at the same time. So last year, Apple made the original movie F1 with Brad Pitt.
Huge hit.
Which we did in IMAX. It was our second best domestic movie of the entire year. The one I just mentioned, Project Hail Mary, we're doing that with Amazon MGM, which wasn't in the business years ago. Greta Gerwig is making a film called Narnia with Netflix, and for the first time, Netflix is going to release it a month early in IMAX, the first time that's ever happened. Then the service, a local language film. About 40% of our films in 2025 were foreign language films, both in their territory and in other territories. So our two highest grossing films in the world were Ne Zha 2, which was in China and did $2.2 billion, and Demon Slayer, which was in Japan. And our network is global. We're in 91 countries. So we don't look at the business the way other people look at it. So, again, to circle it back to your question, I think there are lots of changes and consolidation, but we had 140 pieces of content last year.
Well, does it mean less? Does that combination mean less supply in the market at some point?
Well, I'm saying to you that Paramount is saying no.
Gotcha.
That's what they've represented. But I'm saying when you're doing 140 pieces of content, even those two studios combined are 30 and more coming in. So in the big picture of things, it shouldn't affect it.
I can't help myself but to ask you, any big Oscars predictions?
I stay away from that. That only gets you in trouble.
Right, it does. Lastly, real quick, we've been having a big conversation here at Yahoo Finance on the impact of AI. How is AI impacting the business of IMAX?
Well, I'll start with the film business in general. It hasn't come in full bore yet. I think people are playing around with different ideas. I think mostly they've been used now in the special effects area, because I'll give you an example. If you want to create a sunset over a mountain, you could historically have gone to a special effects house and had that done. Under AI, you'll have access to every sunset over every mountain in the world. So you could retrieve it and develop it a little more efficiently and cost effectively. They're looking at other ways of creating new worlds. The big controversy is around using it in writing materials. The writers union last year had a big dispute over whether it was going to replace writing rooms and things like that. IMAX in documentaries and some things does original content, but basically we distribute global content around the world. So I think the way it would affect us is when different countries and companies evolve in different ways, but it's not like we're developing it in that way. The one place we are developing it is where most other people are doing it, which is just back office, like accounting, marketing, distributing, things like that. That's the way we see it, but we're not leading a revolution to transform production.
Time now for To Watch Friday, March 6th. Starting off on the labor front, all eyes, of course, on that February jobs report. Economists are expecting a much slower pace of hiring, with non-farm payrolls rising about 55,000, down sharply from 130,000 back in January. The unemployment rate is expected to hold steady at 4.3% on a month-over-month basis, while wage growth is seen cooling slightly. Average hourly earnings rising 0.3% compared to 0.4% in the prior month. For markets, key question, of course, is whether this signals a labor market that's gradually cooling or one that is losing momentum quickly. Any surprises could shift expectations for Federal Reserve policy heading into the spring. And speaking of the Fed, investors will be parsing fresh comments from Fed Presidents Mary Daly and Beth Hammack on Friday. With markets trying to gauge the path of interest rates in the months ahead, investors will be listening closely for any signals about how policymakers are interpreting the latest inflation and upcoming labor data. And we're also getting another read on the consumer. U.S. retail sales data for January is coming out on Friday. Economists expecting headline sales to fall 0.3% after coming in flat in December. Core retail sales, which would strip out autos and gas, expected to rise 0.2%. All that new data offering a clear picture of the U.S. economy. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet.